The answer to the question depends a little bit on what type of trader or investor you are.
We're setting a bit of a historic precedent here.
Was it really that event that caused the rally to go up?
The economy is going to start suffering pain.
That's going to be bonkers.
Welcome, everybody, to another episode of Talking Trades. Of course, we have Kevin Wadsworth and myself, Patrick Karim. And Kevin, today we'll be talking to you about proof, chart-defined proof, and how to use that proof to better increase your odds of a successful trade or identifying some key evident points. Please, Kevin.
Yeah, sure, Pat. Well, I don't know about you, but when I'm looking at a chart and think about taking a position, I need that chart to provide me with at least some kind of evidence that my thesis, my scenario is likely to play out. You know, we can all flip a coin, look at a chart and, you know, stick our finger in the air and just hope that the price is going to go in the direction that we want it to. But the whole point about technical chart analysis and technical chart trading is that it gives us a tool that we can use to demand that the chart delivers the degree of proof that we need. Pat, what sort of proof would you kind of, you know, if you were looking at a chart, is there any sort of minimum amount of proof that you would want from a chart to be giving you? I know there's a whole load of sort of weight of evidence, but just what's the first sort of thing that you look for?
Well, let's say I'm an investor, and what I want to know is, am I entering in a trend? Am I entering at the beginning of a trend? Because the only way I can make money, right, is if I enter somewhere at point A and the price moves away from my point A to point B. That's the only way I can make money. So that's a type of proof I would look for a chart to give me, is that ability to see if the price has a higher probability, you know, of trending away from my entry point.
Yeah, very good point you made right at the start there as well. If you're an investor as well, that's something else that we've dealt with before. You know, you need to decide right at the start whether you're, you know, a day trader, whether you're a swing trader, position trader, whether you're investing for the longer term, or even if you're a stacker and you don't really care too much what the price is doing, you're just going to carry on stacking. So the answer to the question depends a little bit on what type of trader or investor you are. But I'm going to share my screen now and just explain a little bit more about what I mean. So here we go. We've got the chart for Bitcoin as it happens on the screen at the moment, and I've put some nice fancy colors on the chart. I'll explain those in a moment. But if you look at Bitcoin over the last 3 cycles, the 3 sort of bull markets, if you like, although, of course, Bitcoin, you could argue, has been in a bull market since inception, but you know what I mean. So the patterns that develop on a long time scale over a period of years give us some very clear support and resistance lines. And I've marked some of those on the chart for you. These red lines show the more obvious support and resistance lines for the long-term sort of bull market breakouts. So in terms of proof, one of the very first things that you want to be looking for to increase your chances of success, as Pat said, is a good starting point. What is a good starting point? Well, a good starting point is 2 things. Firstly, that you are ending a significant period of downtrend. Now, this again depends on your time frame. On this chart, it's a monthly, it's a weekly candle chart. So the time frame on a weekly chart is very different to, you know, if you're looking at an hourly or a 4-hourly chart. But on this weekly chart, you need to be at the bottom of a significant downtrend, and you need to be breaking out. So you can see clearly that in 2015 we reached the end of a long downtrend. Now, of course, as the downtrend is in action, you don't really know when that downtrend is going to end. But we know from other types of technical proof and evidence what to look for. We've covered that in some previous episodes as well. But there are certain key elements that you're looking for to tell you that you're near the bottom of this downtrend. Then you start to get evidence. The chart starts to give you evidence that you're entering a new uptrend. Now, sometimes it's quite dramatic and quite rapid, and you get an upward spike in the price, and then the price consolidates and moves up as it did in 2016 there. Other times the breakout is slower and more gradual and not quite as dramatic. You can see again in 2020, we ended a long downtrend. We formed a breakout and a little pullback pattern, and then off we went to the bull market highs. So if we just focus a little bit more on what's been going on a little bit more recently, one way of visualizing this, and I often use colors to help us visualize these things, is just in your mind's eye, just shade in sort of red the zone or the area that you would consider to be bearish, or where the chart hasn't given you enough evidence yet that it's breaking out into a bull market. And then after that, what tends to happen is that the price will rise to a horizontal resistance level. And at that point, it can either be rejected and continue downwards, or it can actually break out into a bona fide bull market. Of course, by that stage, the price will have risen a reasonable amount. And that's the trade-off between getting the proof and not getting the proof. You either wait for the proof and you enter at a higher point, but entering at a higher point can also give you a very good reward to risk ratio, often better than if you enter at a lower point. So in your mind, shading in these areas of red, orange or amber and green, that kind of helps you to visualize when to be bullish and when not. And at the moment, as we're recording this, and this recording will go out in not too distant future, we can identify a nice clear resistance level at somewhere around 113 to 115. So that is a point at which we need to be very sort of cautious and very looking out for potential rejection. And the support area is somewhere down near, well, it could be down near 80,000 or so at the moment. And if we were to break below that, then, the chart is giving us the proof that we're entering a more bearish period. Now, another set of proof, if I just pop something else on this chart here, and I'll add a couple of other indicators for us, you can start looking at it in a little bit more detail with things like the moving averages and the Ichimoku cloud, which is a support level, resistance level, and also the distance from moving average indicator. And what you'll notice is that the time to be thinking about a long position, the time to be thinking about a potential either trade or sort of more medium-term investment, is when the distance from the moving average is not stretched from the zero line. So in other words, when the price is not too far stretched from the moving average itself. If I just make these moving averages match up, it's actually the 36 period moving average. So if I just put 36 on the chart, so the green line on the chart is now the 36 period or 36 week moving average. You can use 50 week, you can use 40 week. It doesn't really make any difference, because what you're measuring is the distance from the moving average. So you can use a whole range of moving averages and it gives you the same type of result. So again, look at this breakout. Look at the fact that we weren't stretched from the moving average. The distance from moving average was small. And then price accelerates away from that. The moving average starts to move up quite rapidly. And it's when you start to reach sort of stretched levels on the distance from moving average, that's when you start thinking in terms of, well, it would be a sensible thing to start thinking about taking profits. And particularly when the chart itself starts to break down, and you can see here it broke down below the 12 period moving average. So you're getting proof at the breakout point, and you're getting proof when to exit as well. So you can set up a trade and you might have your exit point on the trade at the next sort of measured move level, and you can play a series of trades. It's not just necessarily one trade all the way to the bull market peak. There are a number of ways of playing this, but the point we need to make here is that the chart has to give you the proof before you take the position. And the exit point, of course, that could be a profit limit on your trade, or if you're using trailing stops, then you keep lifting your stop loss, your exit point, until such a time that you feel comfortable that the trade has exhausted itself. And in this particular case, it's when you start getting quite stretched on the distance from moving average, and when you start getting evidence of a trend line breakdown and also a break below the 12 period moving average. So there's a number of different techniques that different traders on different time frames will use to guide their exit point. You can be very mechanical about it and simply exit when you hit your profit limit, or as I said, you can use trailing stop losses and move the exit point up as the price goes up. But get the proof from the chart before taking a position. If you take a position in this red zone, anywhere in this red zone, there's no proof from the chart that it's actually going to break out into a bull market. Yes, there may be all sorts of headlines in social media, and the crypto bulls can be saying whatever they like. But if you want technical scientific evidence. And the same would go, for example, with the gold chart. Certain things happen on the gold chart that happened in the early 1970s, the early 2000s, and recently as well. There's a whole weight of evidence that what happened in the 1970s and happened in the early 2000s is actually happening around about now as well. And if we put a trend line on here, we can sort of see why that might be the case, because the chart has just given us a degree of proof by breaking out through a multi-decade resistance line. So the chart is proving something to us. It's that technical chart evidence where the chart has had 3 touch points on that resistance line and has now broken out. So combine that with other weight of evidence, things like gold breaking out versus the stock market, gold to SPX ratio, the Dow to gold ratio, for example, and a whole host of other evidence. And what that gives you is a point of proof where the chart crosses a threshold and delivers a message. And if you're a technical chart trader, you learn how to interpret those messages and how to interpret that proof path. And that is it for this episode from me.
Brilliant stuff, Kevin. Hope everybody enjoyed that. Make sure to subscribe, like to get more content like this. And until next time.